So, the first thing that I wanted to talk about was your bond thesis. So, you've got this three-phase bond thesis. So, could you go into the details about the bond thesis? Number one, why you're bullish on bonds and sort of the time horizon that you expect this thesis to play out on.
Yeah, that's kind of the big question is that everyone wants to know is, Steve, you've never broken down your whole thesis. It's kind of bits and pieces, and I like to say the macro show is a kind of running soap opera of that. So where I came up with this is years ago, as I was studying the markets and studying macro, is I realized that recessions are opportunities. And our monetary system is defective by design. So while right now no one thinks stocks will ever go down again, they will. And by design of the system, you get recessions. And recessions for most people are wipeout events. They lose their jobs, homes, savings. They lose everything. But for a few people, recessions are a way to really increase their wealth because they can just be correctly positioned. So I became a student of the great financial crisis, and the more I looked at the GFC, I realized that the next recession was going to be a one-off opportunity where the Fed was going to make all the exact same moves they made then, they were going to do again because they still had the latitude to do that. There's still margin. If you go back, there's still margin to lower the federal funds rate down to zero. And today, even though the funds rate is at zero, there's a lot of room to do more quantitative easing. So when you start to realize that the Fed was going to make the same moves they made before, then all of a sudden it says, wait a minute, this is a huge opportunity for me and my clients to increase our wealth by positioning correctly into that downward cycle and then coming out of it as you would have in the great financial crisis with inflation sensitive assets. So I kind of built this three-phase thesis or three-part thesis. I shouldn't say there's not three theses, there's one, and it's built into three phases. You have and the order of it only depends on where you are in the market cycle. So right now, the first phase is deflation, and then you have relatively high inflation, a very concentrated burst of it, and then you get into normalized, inflationary trends. And I broke it down into 3 to 5 year chunks because if you look at a complete market cycle from the bottom of a bull market all the way through to the whole circle, you're going to run us somewhere around a 12 to 15 year cycle, depending on how long the bull market is. And so the first phase is kind of where we're in now and have been in since, say, very early 27, somewhere around 2016, is we've been more in the deflationary phase where we're toward the end of the bull market, the economy is slowing down, and the best way to position yourself to take advantage of that deflationary crash that comes with recessions is the long-term bond market. Now, I know there's a lot of people that say, well, Bitcoin or gold will do well, and they might. I've said, and I'm sure I've said this, that look, I could be wrong on gold, but there's one thing I'm absolutely certain about is how bonds perform or treasury bonds perform in a deflationary environment. So when the music stops and there's one chair left, I know exactly which chair that is going to be. Now, it could be that gold does really well this time. It could be that Bitcoin, because it wasn't around then, maybe it does well. I don't know. But as a money manager, what I look for is, how can I find the highest potential return for the least amount of risk? And that is in the bond market. So that would be phase one. Now, following the deflationary crash, if we go back to the great financial crisis, we saw the year-over-year rate of change of the consumer price index go negative. Now, that's not something that happens ever, but it did. And coming off that negative bound, there was a big surge in inflation-sensitive assets. What might those be? Well, you could go look at gold, silver, gold mining stocks, silver mining stocks, emerging market stocks. You do get a lag going into broad equities, treasury inflation protected securities. These things do extremely well coming off of that bottom because, again, you're going from a negative consumer price index all the way up. So that is phase 2 of the thesis, is inflation sensitive assets, which I've said could run 3 to 5 years. In the past, it's run around 3. So it could be 2 this time. I don't know. I just kind of give it a range, because as a macro investor, I want to set positions and not worry about them day to day, week to week, quarter to quarter. I want to set them and let them, run their distance.
Right.
Phase 3 is where you get into more your normalized inflation. And this is where I think a lot of people will agree that that may not actually happen. I mean, the monetary system, we might see a failure point where we've got a lot of these in-game inflationary views of changes that are likely to come. So now I have a question mark there, but I like to say that if I'm right and I hit these inflation sensitive assets the way I want to in phase 2, the phase 2 might become phase 3 and I'll be okay. So that's kind of the broad thesis of a complete market cycle.